there's a lot of nervousness about taking on duration right now because of all the tariff and inflation uncertainty. On top of that, there are correlations between the fixed income markets of all the countries in the world. I mean, you've got a lot of fiscal and policy uncertainty and inflation recently in the UK. Look what their bond market has done. You've got inflation pressures brewing in Japan, and the BOJ has been like the proverbial deer in the headlights. And now there's talk of fiscal stimulus in Japan, sales tax cuts ahead of their elections coming up in the upper house. But you've seen what the JGB market has done, and that's had a global spillover. Germany blazed the trail, loosening its fiscal purse strings, and that was a watershed event. So you see more bond issuance coming out of the entire continent. So it's been a global move. In fact, the move in Treasury yields has not been in isolation of these other developments. It's not just been a homegrown development. People just focus on the Treasury market and they think, oh, well, there's just broad-based selling of U.S. Treasuries. This is like a negative response to Trump's policies. I haven't seen any evidence of that. It's really been a global move up. As far as it pertains to the United States, I don't believe that these higher market rates are sustainable because of what the small cap stocks are telling you. This is a tourniquet around the small business sector. By the way, the small business sector, when you look at the ADP data, this got lost in the shuffle after non-farm payrolls came out. Small businesses have on net let go employees in each of the past 2 months. That doesn't happen too often. Is it a blip or is it a trend? Because the small business sector drives the overall economy. It's a leading indicator. Look at the housing market. The housing market is in a state of disarray. Even with this move off the lows and the S&P 500, the home building stocks are still down almost 30%. You got affordability ratios for first-time buyers that are about 25% more stretched than they've been vis-a-vis the norms of the past. So what sort of economy? We're going to have an economy that's just going to be built on data centers. You work at a data center, but you don't live there. You live in a home. And the housing market, to me, is the quintessential leading indicator for the economy. And when you're taking a look at housing starts, building permits, and home sales, they're all down over the course of the past year. And it's not as if a year ago we're talking about very good numbers either. Look, if I'm looking at the bond market and I'm saying, well, understandably that we have potential here for a cost shock coming from tariffs, and the question will be how much will be eaten in terms of profit margins and how much will be passed on to the consumer. Right now, the market is very nervous that we're going to have an inflation bump. Everybody's memories of what happened with COVID and with the reopening and with the inflation, that's still seared on people's minds. So they're nervous about extending duration. This is not COVID. Okay, we don't have 80% money supply growth. We don't have the Fed doing quantitative easing. We don't have 0% interest rates. We don't have $2 trillion of stimulus checks. This is not going to be a sustained inflationary development. What's happening here is that the Fed is saying that they're on hold for the time being, and that it will take a major crack in the labor market under the current tariff circumstances to get the Fed to move. So of course, if you're going to get paid 4.4% being in the 3-month Treasury bill, why would you then go buy a 4.5% 10-year Treasury note? Right? So people are just hiding out at the very front end of the curve. I think that makes sense. I'm not saying you got to run out and extend duration today, but I do think you have a 12-month view. The next big move in rates is going to be lower. The economy is not going to be able to withstand this 5% long bond yield, the 4.5% 10-year note yield, mortgage rates hovering near 7%. You look at small business finance costs. They are at punitively high levels. They're like 5% in real terms. So this is not a situation like we had back in 2021 and 2022 and 2023 when bond yields are going up and the economy was surging along with it. Okay, this is a different kettle of fish. This is a situation where this backup in rates is going to end up slowing the economy rather dramatically, and coupled with the fact that I do believe that these tariffs and the price increases that we get from them near term are going to hit a wall in the labor market. I think that we might focus on the 4.1% unemployment rate primarily because of what the participation rate's been doing, but I'm seeing more measures of slack in the labor market than meets the eye. And in fact, just take a look at the recent data, right? Are wages keeping up with prices? No, they're not. And that's already with a 4% plus unemployment rate. We just saw real work-based pay actually contract last month and actually is on a declining trend. So there is no inflation if the labor market doesn't play ball. You get the inflation if we get a wage price spiral, which for an 18-month period in 2022 and 2023, we did have a wage price spiral. That caught the Fed by surprise. I think the Fed is being unduly cautious, but I can understand where they're coming from because they still believe that their credibility has been impaired from what happened a few years ago. Powell's, his term ends if he makes it that far in May of next year. He wants to preserve his legacy. But I would contend that the longer the Fed waits, the more they're going to have to do. And so right now, yes, I'm being a very patient bond investor. I do believe that there is more value in bonds. I know that in bonds, you don't make a killing in bonds like you do in the stock market. If I go to the cocktail party and talk about treasuries, people just yawn or they turn away to speak to somebody else. What a loser. He's talking about treasuries. I want to talk about NVIDIA. But I do think that risk for reward, the bond market arithmetically makes more sense to me right now from an asset mix perspective. You mentioned before about fiscal policy. I said before, most of the growth in the economy post-COVID came out of the government sector. The level of spending in the U.S. government is 53% higher today than it was on the eve of COVID, okay? Not to mention $2 trillion of stimulus checks, endless jobless benefits, rent abatements. This economy was really steamrolling along because of the long arm and deep pockets of Uncle Sam. That's over. Fiscal policy for the next decade is going to be moderately contractionary. And I would posit that when I said before how the U.S. is following Japan, well, Japan did the same thing. Endless fiscal stimulus, but you bloated out the debt ratios with aging populations. And the public sector debt ratio, remember that Rogoff and Reinhardt told us in their masterpiece of about a decade ago that once you cross 90% on the public debt to GDP ratio, you start to impair economic activity. It leads to a stifling in economic activity when we're choking on this much debt. It's a constraint on future aggregate demand. Well, we're at 120%. So the debt ratio as it stands today is actually deflationary. And then on top of that, what about the aging population? As you saw in Japan, even though you will argue, well, that depletes the workforce, the impact on demand from aging populations is materially stronger than the impact it has on wages and labor supply. So the demographics and the debt are very deflationary. If everybody is right on generative AI, then if it's going to boost productivity, by definition, it's going to lower unit costs. So yeah, I would say that most of the factors, not all, you can check off some boxes on the inflationary side, but I think most of the items I'm looking at are telling me that the future is going to be more of one of deflation than inflation. And don't forget, look at asset prices. And I come back to where the bond market's trading. Yeah, we've gone back to 5% on the long bond, 4.5% on the 10-year Treasury note. But in the context of an S&P that's at a record high, multiples that have gone, 26 or so or on a trailing basis. And this is what you got. And you got really a lot of inflation fear at the very same time. So that's why I like the bond market. It's not as if, look, if the bond yields, if we were early in the cycle and we're coming off a prolonged bear market in stocks, if this is like 1982, or if it was 1993, or it was 2003, or it was 2009, and we were coming into an upswing, we had all sorts of cyclical tailwinds in the economy, the stock market was at a low, I wouldn't be sitting here saying, you want to go extend duration. We're very late stage of the cycle. We don't have interest rates very low, we have interest rates very high. We have an economy that's actually not accelerating, it's decelerating. When you average out the Atlanta Fed, the New York Fed, the St. Louis Fed, all their nowcasts, it comes to second quarter growth of 1.9. And when was first quarter GDP? It was negative 0.5. So you average out, people are telling me, look at the stock market, things are booming. But you look at the numbers, real GDP growth is running this year at 0.7%. This time last year, it was 2.3. This time in 2023, the first half of the year was 2.6, 0.7. But you see, I think the folly is that people look at the S&P 500, and so do economists, and they make their assertion on the economy based on what the S&P 500 is doing. But the data are the data, and they're telling you that we are in a stall speed economy right now, and I don't think that's fully priced in. And I know that if it wasn't for all this tariff nonsense, the Fed would be cutting and treasuries would be rallying like crazy. But right now, we've implemented this degree of heightened uncertainty. It seems to have affected long duration bonds more than it's affected long duration stocks. But that's because people have this innate inflation fear coming out of the tariff file. And Jay Powell really didn't help things out too much, because I think he must have said at least 3 times in the past month, starting after the FOMC meeting at the podium, that he's expecting a meaningful inflation spike in the next several months. So, that hasn't spooked me, but for a lot of bond investors, they're pretty spooked by that comment. I'm viewing this as a buying opportunity. I think gold right now, it's entered into a holding pattern. It's had a dramatic rally. You still have deep-pocketed global central banks, and not just the BRICS, that are emerging every month as buyers, they diversify out of US dollars and into bullion. If you want to date the secular bull market in gold, you got to go back to late 1999 when the Washington Agreement was signed, and all these central banks around the world, led by Europe, that had been dumping gold and moving away from bullion reserves for pretty well all of the 1990s. Well, that ended, and I think that was basically the same time that gold bottomed at $255 an ounce. I mean, we're up 11-fold over that period. The S&P 500 is up 5-fold. Gold is up 11-fold since the secular bull market began. It didn't begin just 5 years ago or 10 years ago. It's a secular bull market. Just as people would date the secular bull market in equity starting in August of 1982, this bull market in gold started, it was, I think, December of 1989. So we've done a lot of work comparing the gold cycle to previous gold cycles. We believe that if you're going to give me 3 to 5 years, we'll probably get to $6,000 an ounce. So we're in a holding pattern right now. One of the elements of support, because of course it's priced in US dollars, is that as other central banks are on hold, going into next year, the Fed will be cutting rates. The Fed is far behind the curve. You can't really say that about other central banks around the world. And so as the interest rate differentials converge, the US dollar will come under more downward pressure. And that will be very beneficial for the gold price, alongside all these very favorable fund flow aspects of it, which is coming from the central banks. We can't, after decades of QE, we all know that central banks are very powerful when it comes to influencing asset prices. And until I see evidence that the gold buying program by really about 80% of the central banks around the world are now buying gold, it's not just a couple of central banks, that's going to be a very important development as well.